Hello everyone. So welcome to another playlist on this topic of bonds long-term liabilities. Okay, so this is the topic. Long-term liabilities are kind of liabilities which are having more than 1 year duration. So in this case, a $100,000 bond for 5 years at 10% face value is taken as an example. So right now, don't worry about this. Just try to understand this topic of bonds, which are long-term liabilities. Now, I am making a series of videos. I have one playlist on accounting cycle. I have another playlist on inventory management, and I have another playlist on this reconciliation of cash account with the bank. So there are series of playlists I am making on accounting, financial accounting subject. Similarly, this is one more chapter which deals with investments in bonds. Okay, so and if you had seeing this video directly, you may not understand completely. So first I refer you to go to my YouTube channel and search for the other playlists, uh, especially playlist on accounting cycle, then playlist on cash reconciliation, and playlist on inventory management. After you've seen those videos, if you now come to this video, you will understand this topic. However, if you have a basic understanding of balance sheet and financial transactions and journal entries and all, still you can understand this concept directly. So with that brief background, let me jump into the today's topic, that is bonds, long-term liabilities. Okay, so what is a bond? Bond is a liability for a company. So an investor, so in this case, what is happening? Company needs capital, right? So our company needs money to do its business. So what company does is from time to time issues. So for example, in this case, $100,000 bond is issued by the company for a period of 5 years at 10% interest rate and issued at a face value. Now an investor is interested. So what the investor will do, on 1st January 2014, the investor pays $100,000 to the company. Why? Because company is giving a bond, okay, and company interested in doing some business with this money. So company can earn a lot of profit by utilizing this money into its the company's business. Okay, so what is the company's business that this investor doesn't worry? He has a confidence on the management of the company. So investor is just investing the money, $100,000. In return, what the investor will get? Okay, this is 1st January 14. 1st January 2015, you get 10% interest. Okay, what is the 10% of 100,000? That is 10,000. So 1st January you get 10,000 interest. 1st January of 2016 again 10,000. 1st January of 2017 again 10. Like that, for 5 years, this investor will receive the interest amount. Okay. So now here you see the date, it is same, 1st January 2019, again 1st January 2019, because 5 years is completed. So the company returns the premium amount. Okay, this is the premium amount, whatever was in the bond, that also returns to the investor. So this way the complete transaction is completed. Okay, so again this diagram will help you understand why investor is investing. Investor is investing because effectively investor is giving $100,000, but in return he is getting $50,000 plus 100, so total $150,000 the investor is getting. Of course he has to wait for this much time, 5 years. So there is a 10%. Okay, so this is this one. But why company is giving more money? Because company may be earning more than this interest amount by utilizing this in the company business, and it is earning more money. Okay, so this is the simple concept of why company go for a bond. Okay. Now you can always say, why not company take a loan? Why they are doing like that? So usually loan will have maybe a higher interest rate, things like that. So that's why this is also one more option that the company has to go to the investors. Okay, so this is the basic concept. Okay, so now coming to how the company records this transaction. Okay, so look at this. Company is issuing a bond at a face value. So what will be the journal entries? Because we are looking from accounting perspective. So on January 1st, company received a cash of 100,000. So cash balance will debit by 100,000, and bonds payable, this is a long term liability, that will be credited by 100,000. Okay, so again this is easy to understand. Now on December 31st, that means at the end of the 1 year, what is the interest expense? It is 10,000. And what is the interest payable? It is also 10,000. So under the interest expense account, 10,000 is debited and interest payable is credited by 10,000. Now this interest is payable on annual basis. See here on January 1st, 2015, the interest was paid. Okay, so that's why here you can see interest payable is debited by 10,000. So this and this will cancel each other, and now cash is credited by 10. So from the cash account you are paying 10,000. So this thing repeats. Okay, on January 1, 2016 also same. Interest payable will be like this, and so this repeats for 5 years. And at the end of the 5 year period, your entire bond payable will be debited by 100,000. That means this bond payable and this bond payable account will close, and cash will be credited by 100,000. So these are the sample journal entries for issuing bond at face value. Okay, so these are sample journal entries. So this is about this thing. So how do you record it on the company balance sheet? So company balance sheet will have something like this. So company balance sheet. Of course, I am only doing a partial balance sheet, so that's why I am writing partial. And what will be there on the company's partial balance sheet? It will have long-term liabilities. So under the heading of long-term liabilities, there will be bonds payable. And what will be the value of the bonds payable? It will be 100,000. And this bonds payable will become zero after 5 years. Okay, so this is as of balance sheet as of Jan 1st, 2014. Okay, so like this. So this is a sample, what you call the balance sheet entry like this. Okay. So with this idea, let's continue our discussion. Okay. Now sometimes the investor may not be happy with the 10% interest rate. So, but then this interest rate cannot be changed. Whatever interest rate is defined in the bond, that interest rate holds. But then the investor can negotiate a face value. It need not be exactly face value. Investor can negotiate an effective amount with the company, and they can make the payment. So for example, it is very difficult for the company to find an investor, for example. So this company is not very famous. This company is not very well known. So a lot of investors are not coming for the company, and company definitely needs some money to do the business. And this particular bond offering, nobody taking. No, there are no investor. So in that case, what company can do is offer the bond at a discount. Okay, so what is that? 100,000 bond, 5 years, 10% interest, everything is same, but they are just doing 98% of face value. So they are giving some discount, 2% discount is given on the bond. So in that case, what happens now? You see, this is not industry, this is investor. Now the investor only pays 98,000 on January 1st, and the interest is still same. Interest is calculated on the face value only. Just the payment is less, only 98,000, and 10, 10, 10, 10, 10. 5 times for 5 years the interest is paid, and at the end of the 5 years again the face value is paid, not 98,000. The company actually pays the face value. Okay. So effectively this will become little bit more attractive for the investors. So if they offer a discount, then the investor will come and invest. Okay. So but why company is doing this? Because at least this 98,000 can be put into some business activity, and they can generate some profits, and from the profits they can make these interest payments, and finally they can make the total payment also. So this is the idea of offering the bond at a discount rate. Okay. So here how do we record this on the balance sheet of the company? Because on the asset side the cash is increasing by only 98,000, but on the liability side what you want to keep. Okay, so here you can see it is something like this, company balance sheet. On the asset side, of course, you increase by 98,000 on the asset side. Now on the liability side also it should be 98,000. So what you do, you write bonds payable face value of 100,000 but you will discount on bonds payable, you give make one more entry. It's like just like equipment and depreciation. So this is like bonds payable and discount on bonds payable, you reduce it so that the net liability will be only 98,000. Okay, so this solves the problem that because you received the cash of 98,000 initially, so your cash account asset will increase by 98,000. So your liability should also increase by only 98,000 so that your balance sheet is maintained in balance. But the problem comes after, anyway, these are all expenses, right? 10,000, 10,000, 10,000, these are all expenses. Anyway, these are expenses, but at the end, again, you have to pay back $100,000. So here you need to make a little bit of provision so that you received cash of 98, but you are paying 2,000 extra. So what you will do is that this account, that is discount on bond payable, which starts with 2,000, has to be slowly diminished or amortized. The technical word is amortized over 5 years. So what you do, 2,000 divided by 5, that means the whatever discount amount divided by the duration will give you 2,000 divided by 5 is 400. So what you will do, along with this 10,000, you will add 400 expense. Okay, you will count it as an expense, and that expense you will deduct it from the discount on bonds payable. So when this amount will keep on deducting, then this amount automatically keeps on increasing. So by the, see, at the beginning it is 98,000. So after 1 year, this will become 1600, and this will become 98,400, and this will become 1200, and this will become 98,800. Like that, gradually this liability will keep on increasing. So if I draw a graph, it will be like this. Okay. So year 1, year 2, year 3, 4 and 5 years. Okay. So right now the value is 98,000, and at the end of the 5 years it has to reach 100,000. So each year it will increase by 400. Okay, so how it will increase? So here 98,400, 98,800, 98,000, sorry, 99,200, then 99,600, and here it will become exactly 100,000. So every year it will increase by 400. So what is the meaning of this is increasing? This is discount on, I'm sorry, this is the net liability. Meanwhile, this is called carrying value. So there is another bond carrying value. There is another technical word for this. This is called bond carrying value. Like this. Anyway, we are going to solve an example problem on this so that you will understand, and quickly look at the journal entries for this. Again, these are sample journal entries when issuing bond at a discount. Okay, so first, on January 1st, cash increased by 98,000, whereas because you are selling at a discount, so you are getting less cash. Discount on bonds payable, this is one account which is debited by 2,000, and slowly this 2,000 will be credited every year by 400. Similarly, bonds payable is a liability. That long-term liability has a face value of 100,000. Now, at the end of December 31st, interest expense, see what is the actual interest payable? Actual interest payable is only 10,000, whereas discounts on bond payable will be, here we have debited, here will credit by 400. Therefore, effectively your interest expense will be shown as 10,400. This is a not, you are not actually say giving, see the actual cash payment is only 10,000, 10,000, but in your account books you will write the interest expense as 10,400, which is adding this one. So effectively this discounts on bond payable will reduce. So once this discount on bond payable will reduce, then the carrying value will increase. Okay? And the carrying value keeps increasing like this, and by the end it will become 100,000. Okay? So this is repeated 5 times. Okay? On January 1st, the interest payable is there, and cash only credited by 10,000. Okay? So this is repeating 5 times. So this is the concept of issuing bonds at a discount. Now the opposite can happen. Okay? So again, go back to this one, face value. So the opposite can happen. The company may be very profitable company, very well-known company and all, and a lot of investors want to invest. So in that case, what the company can do is offer a bond at a premium. So instead of selling the bond at 100,000, the face value is still 100,000, but they may sell at more. Okay, so this is the example. So issuing bond at a premium. Okay, so 100,000 bond, 5 years, 10% interest, 102% of the face value. So here they are selling at a premium. Sometimes 103, 105, or even 110% face value they can sell. Okay, so this is the issuing a bond. In this case, what happens? The investor pays $102,000. Okay, 2% premium the investor is paying, and the interest rate is still on the face value, 10,000, 10,000, 10,000, 5 times. And at the end of the maturity of 5 years, January 1, 2019, the face value only is returned to the investor, not the 102, but only 100 is returned to the investor. So the investor, effectively investor is getting less amount for the amount that he has spent, but then the investor is happy that because the company is a very successful one, there is a good chance that he gets the proper payments on time, and there need not be any worry about that. Now in this case, so this is exactly kind of opposite concept. So what we'll do, long-term liabilities, bonds payable is this one, and we are adding, see earlier the discount was deducted less, so here the premium on bonds payable is added, so here it will become the net bond payable is 102. So or this is the carrying value. So carrying value of the bond becomes 102 at the beginning. So again the same concept applies. So at the beginning of the first year, 0th year, 102,000 is your carrying value. So at the end of first year, second year, third year, fourth year, and fifth year, the carrying value again becomes equal to face value. So how it will become to face value? Because every year we amortize the difference. What is the difference? 2,000, right? So here it will be 101,600. Here it will be 101,200. Here it will be 99,800. Here it will be 1,800. Here it will be 1,400, and that 400 will go, and finally it becomes 100,000. So every year we reduce the carrying value. So the carrying value by this amount, so that the what you call the carrying value reduces, and then this premium on bonds payable also reduces. So how do you record this in the journal entries? So again, these are the sample in journal entries when issuing bond at premium. So cash will increase by 102 because you received more cash. Now bonds payable liability will be this, and premium on bonds payable will be credited. Earlier the discount on bonds payable was debited, whereas here the premium on bonds payable will be credited. Okay, so that is the difference. And then interest expense, effectively it will be 9600, but actual interest payment is only 10,000, but then here premium is also on the debit side and interest payable is 10,000, and this repeats for the 5 times. Okay, so I hope this gives a very quick overview of this concept of bonds, why a company issues bonds to the investor, why investor purchases those bonds, and what is the benefit of the investor, what you can see, and what is the benefit to the company, and what is the meaning of giving a bond at a face value, and how will be the balance sheet and journal entries for face value, then the sample balance sheet and journal entries for discount, issuing bonds at a discount. Why bond is issued at a discount? Because there may not be many investors interested in that company, so company will give a discount to attract more investors. And how the money transactions happen, what are the journal entries, and how the amortization happens, and what is the balance sheet. This is for the case of discount, and this is for the case of premium. Okay, so all cases have given. So let us solve some example problems on this so that we get some clear picture. Okay, so this is the introduction video for the new playlist on bonds, long-term liabilities. So see you in the next video, where we will start solving example problems from one of the textbooks, that is financial accounting. Okay, so if you like this video, please press the like button and subscribe to my channel and refer this to your friends. Thank you so much for watching.